Economic downturns have a way of stripping stories down to their bones. In good times, nearly every financial plan looks intelligent. Rising markets reward optimism. Easy credit disguises fragility. Books written after recessions, depressions, and crises are different. They are quieter, less impressed by cleverness, more focused on what survives when assumptions break. The most serious books on financial resilience begin with a sobering observation. Downturns do not create financial weakness. They expose it. Households, companies, and entire nations rarely fail because of one bad year. They fail because their systems were built for growth, not stress. When pressure arrives, only resilience remains visible. Financial resilience, as these books define it, is not the absence of loss. Loss is unavoidable. It is the ability to absorb shock without losing agency. People who endured downturns did not avoid pain. They avoided collapse. This distinction reshapes how money is understood. Wealth is not just accumulation. It is stability under strain. One of the first lessons drawn from historical downturns is that leverage is a double-edged teacher. In expansions, leverage accelerates progress. In contractions, it accelerates regret. Books examining the Great Depression, the oil crises, the dot-com crash, the global financial crisis, and more recent disruptions all converge on this point. Excess leverage turns temporary disruption into permanent damage. Financial resilience requires margin. Margin appears repeatedly as the quiet hero of these narratives. Cash buffers, conservative assumptions, redundancy, slack. These qualities feel inefficient in boom times. They feel essential in busts. Books stress that resilience is often built by sacrificing short-term optimization for long-term survivability. Those who resisted squeezing every dollar of efficiency out of their systems had options when others had none. Another recurring theme is the danger of extrapolation. Humans project the recent past forward instinctively. When growth lasts long enough, it feels permanent. Books on downturns document how this cognitive error amplifies fragility. Businesses expand too aggressively. Individuals overcommit. Governments assume revenue will always rise. Financial resilience begins with accepting that cycles exist, whether or not we feel prepared for them. These books also emphasize liquidity as a form of freedom. During downturns, illiquidity becomes a trap. Assets that looked valuable on paper cannot be converted without heavy loss. Income streams dry up simultaneously. Financially resilient individuals valued access to liquidity over theoretical returns. Liquidity bought time. Time allowed decisions to be made calmly rather than desperately. Another powerful lesson concerns diversification, not as a slogan, but as a lived experience. Books written by survivors of downturns show that concentration magnifies pain. Single employers, single industries, single asset classes. When one pillar fails, everything shakes. Financial resilience spreads dependency across multiple sources so that no single failure becomes existential. Downturn-focused books also examine behavior under stress. Panic selling, freezing, overreacting, doing nothing when action is required. Financial resilience is as psychological as it is structural. Those who endured had pre-committed rules. They knew in advance how they would respond to volatility. This preparation prevented emotion from hijacking decisions. Another theme that surfaces repeatedly is humility. Downturns punish certainty. The most confident forecasts collapse alongside markets. Books show that resilient individuals did not assume they could predict the future. They designed plans that worked even when they were wrong. This humility created durability. Income stability receives particular attention. Many books highlight that resilience begins long before investing. emergency funds, insurance, skill adaptability, side income. These elements softened blows when primary income sources weakened. Financial resilience was built quietly, often unnoticed, until it was tested. Books also challenge the belief that resilience is only for the wealthy. Some of the most resilient stories come from modest households that prioritized flexibility, low fixed costs, conservative debt, strong social networks. These choices reduced vulnerability, even without large asset bases. Resilience, the books argue, is more about structure than scale. Another uncomfortable insight emerges around lifestyle inflation. During expansions, spending quietly rises to match income. During contractions, obligations remain while income falls. Books show how fixed costs become invisible liabilities. Financial resilience requires keeping future flexibility intact. This often meant resisting upgrades that locked in permanent obligations. Downturn literature also reframes success. Surviving without catastrophe is an achievement. Avoiding forced liquidation is a win. Preserving optionality matters more than outperforming benchmarks. These definitions feel uninspiring in good times. In bad times, they are everything. Historical perspective deepens these lessons. No downturn looked obvious in advance. Each felt unprecedented to those inside it. Yet patterns repeat. Excess optimism, overextension, sudden reversals. Books emphasize that resilience is built not by predicting the next crisis, but by assuming some crisis will arrive eventually. Another important insight is that recovery favors those who remain standing. Those who preserved capital creditworthiness and confidence were positioned to benefit when conditions stabilized. Financial resilience did not merely protect against downside, it created upside through survival. These books also highlight social resilience. Families and communities that communicated openly about money navigated downturns better. Silence amplified fear. Transparency enabled coordination. Financial resilience was often collective, not individual. As readers progress through these works, a mindset shift occurs. Money stops being viewed solely as a growth engine and starts being viewed as a shock absorber. Risk is no longer something to eliminate or embrace blindly. It is something to budget carefully. Over time, financial resilience becomes a philosophy rather than a tactic. Decisions are evaluated not only on expected return, but on behavior under stress. Can this plan survive a bad year? A worse year? 2 in a row? These questions shape conservative but enduring strategies. And this is where the story begins to narrow. Because once downturns are understood, not as rare disasters, but as recurring features of economic life, financial planning changes fundamentally. The goal shifts from maximizing outcomes in ideal conditions to maintaining control in imperfect ones. Resilience stops being an emergency response and becomes a design principle quietly embedded in choices long before it is needed, revealing its value only when conditions deteriorate and systems are tested, like a structure that reveals its strength only after the storm has already arrived. And this is where books written in the aftermath of economic downturns deliver their most enduring lesson. Financial resilience is not built in reaction to crisis, but in quiet preparation long before fear becomes visible. In the second half of these books, authors move from diagnosis to behavior. They show that resilience is not a personality trait or a lucky position. It is a set of decisions, repeated consistently when no one is watching and nothing seems urgent. Those who survived downturns did not suddenly become disciplined under pressure. They were disciplined before pressure made discipline fashionable. One of the clearest patterns to emerge is that resilient individuals accepted limits early. They did not assume income would rise forever. They did not assume markets would recover on their personal timeline. They planned for disappointment as a baseline, not as an exception. This mindset did not make them pessimistic. It made them durable. These books also emphasize that resilience is asymmetric. Small buffers create outsized protection. A few months of expenses can prevent irreversible decisions. Modest debt can be managed. Excessive debt eliminates choice instantly. Financial resilience is not about being invincible. It is about staying flexible when others become trapped. Another lesson that appears repeatedly is the danger of false confidence during long expansions. Many people mistake endurance for skill. Years of growth create the illusion of mastery. Downturns expose the difference. Books describe how those who assumed they were prepared discovered they were merely fortunate. Those who knew they were vulnerable designed accordingly. Downturn literature is especially unforgiving toward over-optimization. Systems built to perform perfectly under ideal conditions collapse first. Individuals who budgeted to the last dollar had no room to adjust. Companies that maximized leverage had no margin to renegotiate. Financial resilience favors slack over efficiency, redundancy over elegance. These books also highlight emotional resilience as a financial asset. Panic destroys value faster than markets ever could. Those who survived downturns had already rehearsed fear mentally. They had decided in advance what they would not do. No forced selling, no reactive decisions, no abandonment of long-term plans due to short-term noise. Preparation protected judgment. Another powerful insight concerns adaptability. Financial resilience is not static. Skills matter. The ability to pivot income sources matters. Books show that individuals who invested in learning and adaptability recovered faster, not because markets rewarded them, but because they could respond creatively to change. Resilience included earning flexibility, not just financial buffers. The books also dismantle the myth that resilience means hiding from risk entirely. Avoiding all risk creates fragility of a different kind: stagnation. Resilient systems balance exposure and protection. They accept volatility in exchange for long-term participation, while ensuring that no single shock can end the journey. One of the most sobering realizations in these books is that downturns do not distribute pain evenly. Those closest to the edge fall first. Financial resilience is therefore an ethical responsibility as much as a personal one. Protecting yourself reduces pressure on families, communities, and institutions when resources are scarce. Over time, readers notice that resilience changes how success is measured. Surviving intact becomes meaningful. Avoiding forced decisions becomes progress. Optionality becomes wealth. These metrics feel understated in boom times. In downturns, they define dignity. As recovery begins, another pattern emerges. Those who remained solvent, liquid, and psychologically intact were able to act when others could not. They invested cautiously. They acquired assets at reasonable prices. They repositioned careers. Resilience did not merely defend against loss. It enabled participation in recovery, and this leads to the final resolution. Financial resilience is not about predicting the next downturn. It is about assuming that downturns are part of the landscape and refusing to be surprised by them. It is the quiet decision to design a financial life that bends without breaking, absorbs shock without surrendering control, and survives long enough for opportunity to reappear. If this reflection resonated with you, pause and ask yourself a simple question. If your income or portfolio were cut in half tomorrow, which parts of your life would collapse immediately, and which would remain intact? That answer reveals how resilient your system truly is. Share what this made you reconsider. And if you want to continue exploring books and ideas that prepare you not for perfect conditions, but for real economic cycles, subscribe and stay connected. Because in finance, endurance is the advantage that outlasts every boom.